Hello and welcome back to Options Arena by True Options Masters. I'm your managing editor, Mike Merson, here with Michael J. Carr, Chad Shoop, Chris Cimorelli, and Amber Hestla for the next head-to-head battle of the brains. The topic for this day's arena is recessions. Now, a lot of people are coming out there and claiming that the U.S. is already in a recession and that it's about to get a lot worse. Kathy Wood made headlines earlier this week. I'm seeing a lot of YouTube gurus come out and spout their recession battle plans for their subscribers, but I figured we should get the real experts on the case. So today in Options Arena, each of our True Options Masters is going to have 2 minutes to, 1, tell us, are we in a recession? Is a recession even coming? And 3, if we are in a recession, what is the best way to take advantage and preserve your wealth and even grow it during these tough times? So without any further ado, I'm going to kick it right over to Michael Carr to start. And as always, in our video version of Options Arena, he will have 2 minutes to respond. Mike, take it away.
Okay. As usual, I don't believe I'm going to need the whole 2 minutes. A recession is coming. And this is the ECRI, Economic Cycles Research Institute, the year-over-year 4-week moving average of the growth. We are below the level where all previous recessions started. So we are going to get a recession. ECRI, great pedigree. Jeffrey Moore, who is the guy who came up with the idea of measuring the economy, founded it. So their index, highly predictive. Now, we need to look at more than just GDP. They're going to look at, the economists are going to look at income, output, employment, things like that. Here's income. We are now below trend. So this confirms the recession is imminent. But the question is, did it start? And the answer is no. So here's continued claims. This is insured, unemployment insurance, continued claims. And every recession has started when this moves 11.5% off of its peak, off of its low. That means it's going to be 1.456 million when we have the recession start. This comes out every Thursday, came in at about 1.3 today, well below 1.456. The recession hasn't started yet, but it's coming. So that's that.
Very interesting take. Thank you very much, Mike Carr. Not in a recession yet, but one is coming. Okay, for our next speaker, let's kick it over to Chad Shoop.
All right, thanks, Mike and Mike. That was good stuff, but I have to say, Mike Carr, that's a little scary because I think that we are currently in the middle of the recession. You see Q1 GDP was just revised negative 1.6% to the downside, so that's already 1 quarter of negative growth. The second quarter is negative growth, then we are already in the recession at the moment, technically, according to the textbooks of 2 consecutive quarters being negative. But for me, what I'm watching that really makes me think that we are in a recession is the Federal Reserve, because they're battling inflation right now. And even Powell said last week that he understands that there's risk to the economy. While they're raising interest rates, his whole goal is to slow down the economy, to cool off inflation. And there's a risk that we go into negative growth, which we are already seeing in Q1. But he said that the bigger risk is that they don't get prices under control. So they've already admitted that, a recession in the economy is not really a big concern to them right now. They have to get inflation under control. They're hiking interest rates this month. In July, they're expected to hike them again. So that tells me that as long as the Fed's hiking interest rates, we're going to stay in a recessionary period. And once they stop, that's when I think that we can see things turn around for the stock market. So I'm going to be watching the Fed a lot closely here during this economic times as we're in a recession. And that'll be kind of my cue on things to look for it to turn around in the stock market, because when it comes to investing and trading in the markets, look, prices are always leading this economic data. So we are already seeing a weak stock market. We're in bear market territory, and that's based on this weak economic data that's coming out now. So I think prices are going to stay ahead of it. So by the time they say we're in a recession, you can ignore it for the stock market and continue to trade in the stocks that you like and look for the rebound.
Chad, with a very common sense, no chart required approach. Watch the Fed. Fed will let us know when we're in a recession, and when we're out of it. Okay, for the next one, I want to hear what Amber has to say about the U.S. in a recession.
Okay, so economists use real data when defining a recession. Real data is adjusted for inflation. So considering inflation, the economy did contract in the first quarter, dropping 1.6% compared to the previous quarter. Now the definition is loosely 2 quarters of negative growth, but economists use other data, retail sales, income, and employment, for example. So to determine, that's to determine when the economy entered and exited a recession. So in the chart, we see there were 2 consecutive quarters of real GDP declines in 2020 and the 2009 recession, but a quarter of growth interrupted the contraction in 2001. So that all means we might already be in a recession. My next chart is in retail sales, and it's adjusted for inflation. Sales have been choppy, but they were down last month and very small, up 0.3% in April, the first month of the quarter. So I do expect to see weak sales in the June data, which will mean a negative quarter for sales. So the reason I do expect a down quarter is because of gas and food prices. Many of my friends have babies or toddlers, and they're all concerned about the price of diapers. They're also concerned about the price of formula, and that's if they can find it. They're also worried about the price of gas that's required to track down that formula. So it is forcing them to make some tough decisions. Young families can't do without diapers, formula, and gas. So those discretionary items, they do get cut out. And I actually found a poll that supports this. So 84% of those respondents are eating out less often. More than half have changed how they shop at the grocery store. They're spending more for less. So that's why I expect a decline in retail sales for the quarter. Consumer spending accounts for about 2/3 of GDP. So the rest almost evenly split between government and business spending. As consumers cut back, the economy will contract. So odds are we're in a recession right now. If not, we will see a recession by the end of the year. My favorite idea right now is land, raw land that can be used productively to grow crops or graze cattle. Land has been a great inflation hedge in the past. Pull up the chart here. The chart shows how farmland performed after inflation. So the consumer price index increased an average of 7.8% in the 70s, and farmland beat that by 11.1%, gaining 18.9% a year during a decade when stocks were struggling. So the S&P 500 averaged 3% returns in the 70s, failing to keep up with inflation and leaving investors poor in real terms. So we may not be about to repeat the 70s, but it really doesn't matter. Land has always beaten inflation, and it's likely to continue that trend. I like actual land, but Farmland Partners, which is FPI, it's publicly traded. They own over 15,000 acres in 16 states. The land is rented to farmers who grow more than a dozen crops, so it's pretty diversified. The yield is 1.7%, so you get some income and inflation protection.
You're only about a minute and a half over time, Amber.
So with that being said, FBI is my preferred trade. There are some February 2023 options available that you can look at, but all in all, I am expecting a recession soon.
All right, thank you, Amber. A little bit over time, but we highly appreciate your practical plan for fighting a recession. Farmland, that's a very interesting idea. One that some of our subscribers might be hearing about more in the very near future. Okay, last but certainly not least, we have Chris Cimorelli. Chris, what do you have to say about this?
I certainly am least, but I'm going to say we are absolutely in a recession. I think it is logically incoherent to suggest anything to the contrary. You don't need to look at a chart to reach this conclusion, but I'm going to show you a couple of charts anyway. This is a chart of gross domestic product. If you look at the 1 year, which we are set to, you see it went up. But what is gross domestic product? It's only partially real. It is a number without context. To get the context, you need real gross domestic product. This is GDP adjusted for inflation. And if you look at the 1 year chart, you can see it has started to turn lower. That's not good. But an even more damning chart is this consumer sentiment survey from the University of Michigan. As you can see, sentiment has not been this bad since 2011. Now, of course, in 2011, we thought we were entering another bear market after the financial crisis of 07 and 08. We did not. It rallied back. But the point remains that sentiment hasn't been this bad in really a decade. So Economic data is, of course, a lagging indicator. It tells you what has happened in the economy. But to look for a leading indicator, we can look to the stock market. The stock market is largely considered one of the leading indicators. And of course, the stock market has been in a downtrend. We have seen a little bit of optimism in recent weeks anytime the Fed announces that they're going to aggressively raise rates, but then we see the market do a head fake. It turns up, it turns into a sucker's rally, and it goes right back down. Why is that? Because investors realize that the Fed is taking the punch bowl away. By raising rates, they are taking away the catalyst that allowed a more than 10-year bull market to blast stocks to all-time highs. Now that that's going away, we're really kind of getting eaten on two fronts. So we've got inflation, which is horrible, and the only weapon to fight it is raising rates. And raising rates is ultimately bad for the stock market. So there are two reasons here. In the short term, investors might like seeing rates go up, but then they have to wake up to the conclusion, oh, inflation is back under control, but now we have ultra high rates. That's not good for the stock market. So it's a damned if you do, damned if you don't situation. Stocks are a leading indicator of the economy, and we are seeing even the lagging indicators showing a new trend could be starting to take place. A trend has not started yet. One piece of data does not a trend make, but I think logically, the only conclusion to reach is that we are already in the recession. So what do you do in a recession? I think buying farmland is great. It's a bit expensive. Of course, Amber recommended a low-cost way to get exposure to farmland. Farmland is one of those investments that really has not had a down year in really 20 or 30 years, so it's a great thing. Land is the only thing I own that has gone up for the past year. Thank God for it, because otherwise I'd be horribly down. But my recommendation is to trade straddles. Straddles right now are a great sort of tool you can use. They're kind of a cluster shot in a sense, where you don't have to be super accurate to make money. You may not make 100% in your trades, but you can make 20%, you can make 50%. And what you can do is you can trade straddles on the S&P 500, you can trade them on Apple, you can trade them on Amazon. Those two stocks are great proxies for the overall market. And to buy a straddle, you simply buy a call and a put option at the same strike price. A strangle is another option where you can buy a call that's out of the money and a put that's also out of the money. So you're buying different strikes in your call and your put. The straddle is going to be a little bit more expensive. The strangle will be cheaper, but of course a cheaper security is going to be much more volatile. So you may invest less money, you might trade less money, but it will have wilder swings. But the way you make money on these trades, straddles or strangles, is you simply let the market move, which the market's moving a lot right now, up and down. And when you buy one of these things, it just has to go blast off in one direction. It doesn't matter which one. So you don't have to be right. This is a way to perhaps get a higher win rate on your trades right now. But of course, the better thing to do is to use time indicators, such as the ones Mike Carr uses in One Trade and Precision Profits, his volatility watch indicator and his greed gauge. When you have tools like that, you don't have to buy things like straddles and strangles. And now you have a fairly precise measurement of which way the market or security is going to go. And you can simply buy a call or a put. But if you don't have access to One Trade, Precision Profits, which you should, but if you don't, straddles and strangles are the way to go right now.
Chris, I can't believe you got all that in 2 minutes. That was just a remarkable
that was 2 minutes? It felt
Not
like
even
4.
close. No. I think what this options arena has shown us is that the timing function of it should be thrown out the window, because 2 minutes is not nearly enough time for our gurus to give you their best ideas. So I'm sorry we shortchanged you this week, Mike Carr and Chad, but next week, no more timing. I want you guys to go all out and give us your best ideas. And I want to thank you all for the great spread of ideas. Yes, we are probably in a recession. Times are probably going to get a lot harder. But as Chris and Amber and everybody has shown you today, there are things you can do to improve your situation and not suffer inflation, not suffer higher interest rates, and not suffer losses in the stock market. As always, we will put a poll in the description below so you can tell us whose guru's prediction you like the most. And we hope you join us next time for the next video edition of Options Arena. I'm Mike Merson. This is True Options Master signing off.
Hey, and don't forget, if you like this video, please like, comment, subscribe, share True Options Masters with your friends. We're growing our channel rapidly. We're adding tons of new strategies. Subscribe to our daily e-letter. It goes out every single day of the week, Saturday and Sunday included at 11 a.m. #1 site online for options trading research and education. Share it everywhere. Thank you.